Hi, it's Mel Dennis here from Domain & Co with our professional property series. Today I'm sitting here with Hairul from the NumberGroup. Welcome, Hairul.
Thank you, Mel.
We thought we'd go over today CGT, or capital gains tax, as you may better know it. There's always confusion around when that's going to hit, particularly if it's been a principal place of residence versus just being an investment property the whole time. Do you want to run us through some of the scenarios where CGT is going to, hit a landlord?
Yeah, of course. So, rule of thumb is if it's an investment property, you purchase it as an investment property. The day you sell that investment property, you'll be liable for capital gains tax, CGT. You will get a discount if you hold the asset over 12 months. You'll get a 50% discount on the profit of the sale. But if it's a scenario where this property that you sold, which is your investment property but initially was your main residence, it could be CGT free, or a portion of it could be CGT free. So what the ATO has determined is that if a property is your main residence, a residence that you like to live in and you own, when you sell that property, you should not have to pay any tax on it because it's not an income generating asset.
That's just when you've lived in there the entire time.
Correct. So obviously not everyone will have a property that they sell that was investment specific, circumstances changes, so it might be your main residence for a point in time when you first bought it, but then you moved on to a different property, you might rent this property.
That out, yeah.
Right, yes. So
it happens a lot. You see people outgrowing the homes they're in, they keep that one for an investment and they go on to their next one.
Correct. So firstly, let's establish the fact that at one point you can only have one main residence, and you'll make that election to determine which residence is your main residence, because that will determine the exemption or non-exemption of when the asset is sold.
Right.
So in a scenario where a family decides to move out of their main residence interstate and they are renting that property out, what happens is that they have a 6-year rule.
Okay.
So up to 6 years they can rent their main residence, and if they were to move back into the property and down the track they were to sell it, that property will be tax-free.
Still the CGT free.
CGT
What
free.
happens if they move out for a period of say 5.5 years and move back into or sell the property, sorry?
Yeah.
Would it still be CGT free at that point when they sell?
It will. So if the asset is generating income and it's under that 6 years, it will be CGT free.
So no matter what, it's always CGT free?
Yeah, within that 6-year rule. But what we have to be careful is that, say for example, the 6 years has lapsed and it continues to generate income. So the day that 6 year comes in, that's when your property will then be liable for CGT. So to put into practice, say you bought a property for $500,000. When you decide to, and then rent it out down the track, and then the 6 years lapse. At that point, when that 6 years lapse, it's now worth $1 million, and then you sell it 10 years down the track for $2 million. You won't be paying capital gains on the 2 mil, but you'll be paying capital gains on the 1 mil.
Right, so just where the cutoff for the value when that 6 years came into play.
Correct.
So important then, I guess, to note that that's a great time to get a valuation from your real estate agent. In the form of a letter, would that be sufficient to say this is what the value is, or do you need something a little bit more from a valuer? Or
yeah, so the beauty of our tax system, it's all about self-assessment. As long as we can justify the valuation, it's good enough. So it could be a scenario where you can get 3 different valuations at a point in time, and if those valuation in your opinion is that it's a bit lower, you can tell your accountant that, look, I've got 3 valuations here sitting at 1 mil, 1 mil 50 and 950, but I truly believe it's 1.1 mil. We can indemnify that, because what we've done is we've done the due diligence, and at the end of the day, sometimes your idea of the value of the property is a lot better.
Yeah, for sure. And we have a lot of clients looking to sell their investment properties that they have lived in before, simply because the CGT is now coming into play from the 6 years.
Yep.
What do you think about that sort of scenario when someone's selling just because of the capital gains implications?
Well, I think.
Or that each property is individual. So if the property is going to continue to be a good investment property, it may not be a great reason to sell. But if it's a property that's not particularly great as an investment, maybe it's something worth considering. Those sort of things need to be taken into account as well.
Exactly. So one thing that you want to consider is the impact, right? So for example, the impact on your net takings. So if you sell it post main residence exemption, you'll have to pay a portion of your takings in tax. You value, you'd have to value whether or not is the market conducive enough to build in the tax, or it's not. It's as simple as that.
Okay, great.
Yes.
Well, some great tips around the capital gains tax and CGT from Hairul. If you are looking for any more information, please let us know and we can get that information to you from Hairul. Thanks for watching.